Hi, my name is Jordan Wilson. We're back today with part two of investment returns. In part one, we covered different time periods associated with investment returns, total, annual, holding period returns. We also looked at the different return types, comparing expected versus nominal returns, and how you should compare your nominal results, what actually occurred, with real returns. So how inflation impacts your overall performance. The risk-free return. How you owning a risky asset compare to an asset with zero risk. And then finally, we looked at different return types on a relative basis. How is your performance, your nominal return, versus your historic performance as a company, versus expectations based on analyst estimates? How did your asset compare to its peer group, the industry as a whole in which it operates? How did it compare to the market overall? So these are things that you want to look at when you're looking at different returns. You can't just say a 12% return or a 25% return is good. You have to compare it against other options. So today we're going to look at comparison with a few different types of returns. We'll also look at mean returns as well as the problem with arithmetic means as a tool to measure return performance. So on a return comparison, the common ones tend to be gross versus net returns. And the difference is that net returns are after expenses, transaction costs, management fees, taxes, those sort of things. The biggest issues tend to be management fees. So that may be the administrative and management fee if you're in a mutual fund that's actively managed. Those tend to eat away a fair bit at performance. If you're in a non-tax deferred investment account, so not for a Canadian citizen, an RRSP, then you may have tax issues every time you buy or sell an investment, capital gains, for example. Or you may experience tax on interest or dividend income that you receive. So again, management fees, administration costs, and taxes can greatly erode your performance over time. On a realized versus unrealized basis, an investment is not realized until the money is actually in your jeans. Now, unrealized gains may actually lead to bad decision making in life. And an example in recent times was the housing bubble. So many people had significant equity built into their value of their homes just because the homes had appreciated. And so many people decided, okay, I'll take a home equity loan based on that. And the banks were very happy to push those products on their clients. But then suddenly the real estate market in many parts of North America crashed, sort of in the late 2000s, sort of 2008, that sort of range. And suddenly people whose house might have been worth $1 million, and that led to an equity loan based on that, the house is now worth $500,000, and it's underwater as far as the valuation against the debt. So that would be an issue where people are acting based on a perceived value, and it's not actually money in your pocket until you actually make the sale. So be careful with that. The other issue between realized and unrealized that can be a problem for some people is that tax may be assessed on unrealized earnings. So perhaps a dividend is declared before year end but not paid out until after. You may be subject for tax in that prior year just based on when the dividend was declared as opposed to paid. You may be in certain fixed income products that don't pay out. You buy them at a discount and they mature at par. You don't receive interest income physically. Yet often you may have to be liable for the deemed or the accrued interest that you haven't actually received. So just things to think about as far as that goes. I'm a big proponent of dividend reinvestments. So if you have a common share that issues dividends, to enter a DRIP program so that you reinvest that money back into the shares of the company and helps you grow over time. There you technically receive it because you basically receive the dividend and then immediately reinvest it in the company, but you never see the cash, yet you're still liable for the tax on that. So that's realized versus unrealized. Base versus local. That's another issue, and it's more of a foreign exchange issue. Your base currency is probably your domestic currency, your home currency. If you live in Paris, the euro. If you live in Washington, D.C., US dollar, Toronto, Canadian dollar. But a lot of people will invest internationally. So you've got to factor in the base currency versus the foreign. And by that, that's the foreign exchange. Okay, let's turn to the arithmetic mean, which is probably the most common mean calculation. The arithmetic mean is just the average of all individual data points. Another thing that we calculate daily in life, so we're all familiar with it. You add up the results, divide by the number in the sample or the population, and that gives you an average, in this case, the mean. We'll get into this a little bit later, but means are good for independent data. And if we look at an example, easy example here, we have historic returns of 10%, 5, 22, 12, 11. So we add them up, we divide by 5, we have a mean return of 12. And that's fine. On average, over the last 5 years, we've returned 12%. If we differentiate that from median return, the median is just simply the midpoint of all individual data points. Now you have to sort or rearrange the data in ascending order, and then you take the midpoint, and that's your median. In our example, if we rearrange in ascending order the returns, we now have 5, 10, 11, 12, 22. And the midpoint, in this case, is 11. There's 2 returns on either side of it. It's the midpoint, 11. Now, the problem or problems with arithmetic means is that, one, outliers can greatly skew the usefulness of the amount. So if we just look at the quick example that we did there, let's say that in year 3, the return was 220, not 22. Suddenly our mean return becomes 51.6%. So we have 10, 5, 220, 12, 11. And that turns our average into 51.6%. Doesn't really jive with the other 4 years. Now again, in that example, the midpoint or the median is still going to be 11, just because of the outlier doesn't really impact medians as much. So medians are a slightly better tool if you have outliers that skew things. Also for very small sample sizes, because in a small sample size, 1 or 2 items can have a large impact. If we have 1,000 data points, that 220 won't have a huge influence overall, but in only 5 samples, yes, it does. So that's kind of an issue. 51.6% probably isn't a representative sample average for that time period. And in the real world, what you might find is, you go to a mutual fund salesman and they tell you, this fund has averaged 51.6% over 5 years. So you may think that's indicative of next year's performance. But in reality, 4 of the 5 years were very much lower. So you need to be just aware of that. The other area is that investment performance is independent. And what I had said above was that arithmetic means are good for independent data, not so much for interdependent data. And a good example there, or a very short example, would be if you have a return 3 years minus 10%, 20%, and 5%. Your average return is going to be 5% over that 3 years. But investing is not independent. So if I had, I don't know, $1,000 and I lost 10% that first year, I'm not starting with $1,000 the next year when I earn 20%. I'm only starting with 900. And then the following year, again, it's different. It's not starting at that base of 1,000. So you can't really just take an average, because what you did in year 1 sets up your valuation for year 2 and then year 3. So interdependent returns and results, not so good to use arithmetic means. And again, we just talked about the negative returns in that example, hurting the return assessment. But we take it even a step farther. I've got $1,000. And let's say I earn 100% in year 1. Then I'll start year 2 at 2,000. But what happens if I lost 50% in year 1? Then I've only got $500 in capital. And if we take a very quick example, 2 years, I invest $1,000. I lose 50%. So I'm down to 500. And then the next year I gain 100%. So 500, 100%, I'm back at 1,000. In the 2 years, I started with 1,000, ended with 1,000. So I made no money. I mean, that's obvious. But if we do an arithmetic mean calculation of that, minus 50 plus 100 is 50 divided by 2. The arithmetic mean tells me that I had a 25% return. And that's not correct. So again, negative returns can reduce the effectiveness or the usefulness of arithmetic means, and at times make them completely irrelevant. To try and counter the negatives involved with arithmetic mean return calculations, we tend to see 2 weighted returns, the geometric, also called time weighted. And that just calculates the compound growth rate over the time period being evaluated. It also assumes that all cash flows are reinvested. So where arithmetic is good for independent data, for example, I'm in a classroom of 30 students, and my results on my exam, unless we're all cheating, is independent of the people beside me. So that's independent. My mark on the exam has no impact on other people, and they have no impact on me. Pretty much the same if I'm standing, take those 30 students and stand them in a row from tallest to shortest. The person next to me has no impact on my own height. It's all independent. Now again, geometric does factor in that. At the very bottom, the example that I discussed on the previous slide, with arithmetic, my return of 100% and negative 50% in 2 years means I'm back at 1,000. 1,000 times 100% is 2,000. And then I lose 50% the following year, I'm back to 1,000. That 50% is interdependent on what I did in year one. If I had only returned 50% in year one and had gone up to 1,500, that 50% loss is now $750, not 1,000. So what you did in the past reflects what you do in the future as far as investment returns. Meanwhile, the arithmetic mean is telling me I earned 25%, when in fact I earned nothing over those 2 years. The geometric calculation would have told me 0, and that's correct. The other one you'll see is dollar weighted. That calculates an interest rate that equates the present value of cash flows over the time period being evaluated and factors in the end market value versus the opening market value. Essentially, it's an internal rate of return calculation. It's useful in some ways as to the growth of the portfolio, but it's less useful and not often used to evaluate the portfolio itself. And a big reason for that is that there's so many external factors that can impact your dollar-weighted return measures. And what we want to do is we want to assess portfolio manager performance. And it's hard to do that fairly if external factors come in play. For example, changes in the funding. So if a client contributes to the fund or the asset or makes withdrawals over the time period, that's going to impact your dollar-weighted return. It's got nothing to do with the performance of the asset manager. And so it makes it tough to compare two managers to each other because they're dependent on what the clients are doing as far as withdrawal and contribution rates in this case. So I wouldn't put too much stock in dollar-weighted returns, geometric much more. Okay, that's the look at parts 1 and parts 2 on different types and different terminology for investment returns. Thank you for listening today, and have yourself a great day.